And we're live. Phil Tarrant, Tom Panos, Real Estate Exposed, where you get the information you need to know about operating in real estate. Tom, we talk about what's happening in the market, how it's connected in with what's going on in Australia, and sometimes, often led by you, say some things pretty polarizing, which seems to be quite popular with our listeners and also our viewers live across all the different internet channels. Tom, how are you?
I'm good, Phil. I'm good. And look, on the issue of polarization or simply having a strong, loud opinion, I think, Phil, if you don't, you can actually end up becoming no one to anyone. And there's just so much content on there now between podcasts and live streams and video. And you really do need to take a position, because if people are going to tune in and say, oh, well, they just constantly sit on the fence, we know what they're going to say. At the end of the day, it'll be, oh, yeah, good time to invest, but as always, take caution, right? People sort of know that. So, look, at the moment, Phil, as I'm talking to you, I'm looking at my financial review app on my mobile phone, and I don't know about you, but it just seems like in a matter of 90 days, we've just gone into catastrophization of real estate. House prices to fall, the biggest fall in 40 years, says this one here in the AFR review article that appeared today, or might have appeared yesterday. And it goes on to say the housing market correction already underway could accelerate into the largest on record, with a peak to trough decline of 20%, and even more in Sydney and Melbourne as borrowing costs rise more sharply, according to Jarden. And it goes on. And, you know, our forecasts are we would see around a 25% fall in borrowing capacity by the end of 2022. And then it goes on to talk about the declines that they anticipate predominantly in Sydney and Melbourne. And the article then says that Dr. Lowe, and I'm not quite sure where Dr. Lowe's from. Is he from the Reserve Bank? I'm not quite sure. Dr. Lowe goes on and says markets are now pricing a 50% basis points rate jump in July. And that's quite possible, isn't it, Phil?
Yeah. Look, I'm not privy to the goings on inside of the Reserve Bank of Australia, but all of the major banks are pricing in more rate rises this year. You know, there's a comment here, Stephen Koala, a recession voice that's on its way. Depression is coming. What's he say after that? Then there's a boom, right?
Well, then we've got Stephen Koala, 2 years of pain until the next boom. Yeah, so...
so I don't know. But, yeah, price in, expect more rate rise. And this goes and lends to the comment or the commentary we had last week, Tom, where you were scoring the Reserve Bank of Australia a 1 out of 10 for accelerating interest rate rises when they said they wouldn't have been in the 2024. My response to it, well, the market has changed considerably since then. All these supply chain constraints that we didn't expect to have. But inflation globally in the Western world is spiking right now. Whether or not it leads us to a recession, there's commentators in the US pretty much saying it's a 50-50 chance of it happening there. Look, we're able to dodge it largely here in Australia despite COVID-19, and we technically moved into a recession for a period of time, but we bounced out of it pretty quickly. Look, you know, it's a tough market. We spoke about this. Get your household finances in order to weather whatever happens during this period of time. But let's remember, Tom, interest rates were at their lowest level in history, 0.1%. They're back to 0.85% of the official cash rate. When I started investing in property, it was significantly higher than I was paying 7% on mortgage rates for interest only. So, you know, people have a very short-term memory. Interest rates are still pretty cheap, mate. Here's Martin Walmsley. It was only 24 months ago. I was writing loans at average of 4.2%. There we go. So the period that we've just gone through, the last 18 months, is an anomaly. We're moving back into normal market conditions. But what you're seeing right now, Tom, is fear-mongering about it. Those headlines about property dropping 25, 30%, let's go back back in time, 2 years when the the COVID-19 pandemic started, we're seeing exactly the same headlines. What did we say back then? What are we saying this time around? What's your call?
My call.
Just hold you to it.
Phil, my call is that the media is writing about 10 and 20% falls. My call on it is it's already been done. Most of the fall has actually happened. And I don't know whether it's the fact that the data hasn't come through Land's Titles Office, and then it doesn't allow journalists to actually sit there and write articles on it, having up-to-date data. But from someone that's actually on the coalface doing deals, I'm walking away from properties thinking to myself, that should have got 1.4, it got 1.3. I'm seeing the decrease already now. And I'm also seeing, and this surprises me, Phil, is that there's a group of buyers that are intelligent enough to know that, hey, I would have paid 1.4 a few months ago. I'm buying it. And that's why you are still seeing sales happening. There are people out there that were saying, hey, I'm saving $100,000 at the moment, right? I'm not worried about all this the fuss. So what my call on it, and I'm saying it here, we probably will see a little bit more softening when there's more stock on the market, and that's going to happen in around September, October. It's become very clear to me there is going to be an exodus this year of people travelling from Australia going overseas. It's very clear. We can see that with the passport lines and the queues of people trying to get there. But I can also tell you a lot of the real estate fraternity have made up their mind. They want to. It's a combination of haven't done it for 3 years and the super cold weather. So they are ducking away. I'm expecting a lot of stock to hit the market, Phil, in September, October, November, and there'll be a further softening. But I don't think any of these journalists that you're reading about that are making statements of 10, 20, 30% over the next 2 years, man, seen it before, heard it before, and it never eventuates. Right?
So here's a question for you, Tom, and you're probably not going to make friends with how you answer this. You've been in real estate for many, many years in many different capacities, sales coach or coach, auctioneer, but your main job for that period of time was leading advertising inside of the big newspapers, which generated most of their money from real estate, right? The question for you, how many journalists have you come across who are property journalists in the last 20 years actually know a little bit about real estate and invest in real estate themselves?
Not a heap, Phil. And the reason why is in the world of journalism, real estate is not the trophy job, right? It's not the trophy job. In fact, often you find that people that work as editors or journalists in a media company will have real estate as their least preferred department to work for. They find it boring. They find it doesn't have the excitement of, say, crime, politics, right? So it's something that, and then of course the other issue is that you've always got this. Look, it exists less now, but you had these media companies relied on real estate print revenues. So there was always a feeling like, let's not talk the market down too much here, right? Because we're actually upsetting our biggest advertisers. And real estate, look, the truth of the matter is real estate underpinned most print media over the last 2 decades, right? Ready-made ads. There was very little graphic design. They were coming in from third parties. They were getting published. It was vendor-paid advertising, so there wasn't a lot of pain point from the actual person placing the ad. But to answer your question, and this, look, there are some better than others, but for the majority of people that work as journalists in real estate, they don't do it as a long-term role. They're doing it as part of their transition career in media, and often, often they want to move on. Look, I'd probably be, who knows? I love real estate, but if I was a journalist, I'd probably be saying, hey, I want to be with the sports players. I want to be with the Socceroos in Qatar, right? I want to be following Roger Rogerson's case, right? Maybe I'd be the same.
I don't know. Well, maybe I've got something completely wrong because I'm a journalist and I specialise in real estate. So maybe I'm just mediocre, mate. No one's ever given me another job reporting crime or anything. But I'll put it out there. Our real estate team here at Momentum Media, in terms of journalism, is the best out there. REB, for example, led by Grace Hornsby, great operator. She knows real estate. She cares about real estate. And my argument around is that journalism in real estate is probably one of the most important segments of it, because property in Australia underpins the economy. So you're actually talking about stuff that actually matters. I think 1 in 8 professionals or people in Australia are somehow connected with property, which fuels the economy. That'd be my response to it. And I get a real satisfaction about reporting on reporting on real estate as a journalist. But Tom, mate, you're a real estate journalist. I'm telling you right now, you're a journo, mate. You provide commentary and insights around it. You write, you do this in podcasts. I'm going to put you as one of the great real estate journalists in Australia, Tom Panos.
Yeah, I'm very mindful. I've got to tell you, I'm constantly I'm doing market wraps on a Saturday afternoon while I'm driving, which is not the right thing to do. And it'll take me 2-3 minutes. I'll get 60, 70,000 views. People are fascinated to hear what has just happened there and then, right?
Mate, that's journalism. That's journalism, Tom. I don't know what else it is.
This is journalism. And guess what? Bill, someone said to me during the week that you and I were more accurate at predicting what prices did during the COVID lockdowns than they said the experts. Well, I said to this guy, well, we are experts, right?
Well, you are.
We're both working. We both, still got a contract with News Corp. We're both working in media. We both work in real estate. But you put me on the spot. What about you? What do you reckon? I reckon there's still a small softening, but I'm not thinking 10 to 30% more. It's already. Yeah. I agree with what this gentleman here has said. Sam, market's already down roughly 10.
Yeah, look, and I tend to agree that now. With a journalist hat on, what I would say to that is I don't sit around and wait for the data feeds to come from CoreLogic and other data providers, right? I speak and I connect in with information, market intelligence, situational awareness, whatever you want to call it, at the source. And Tom, you're at the coalface, and real estate agents are at the coalface. So that's where I get my interpretation of where the market is. Yes, it is softening, but not everywhere, Tom. Not everywhere. And you're going to get a 2-speed market. Put me on the spot. You're going to get a 2-speed market for this next period of time until we actually understand what's happening with inflation and the ramifications and impact of it. They're saying sort of 7% inflation. Like, that's a big number, right? It's a very, very big number, and it's complicated. There's so many moving parts to this. We spoke about this as we were narrating the run up to the election, saying whoever gets the gig in this next period for Australia has got a tough job ahead of them, and they've got a hugely difficult job ahead of them. Albanese and the government that he's formed, trying to balance all this sort of stuff. It is tough times for Australians' hip pockets.
I had a flight to Perth, to Perth yesterday. Day before and yesterday, over a 24-hour period. I'm sitting on a flight back with a guy who is an economist, and we have a quick chat. And he really gave me a very good understanding of inflation. I mean, I don't think about it, but he said, so just picture, he goes, you've got a $10 note, and this $10 note is worth $10. And that $10 can go off and buy various things. And then all of a sudden, there's a crisis going on, and the government's concerned for their people, so they want to help them. So what they do is they print out all these extra $10 notes, and they just give them out. So all of a sudden, the original $10 note is not as valuable, right? Because there's more of it. So what actually happens is the value of the $10 goes down. And the reason it goes down is that for you to actually buy what you were buying before for $10, you can't. That is what inflation is. So this is being caused by what appears to be a fear of governments. Were worried. They looked after their people through various grants. I mean, I've still got on my phone, I've got a reminder here saying, use your your vouchers at hotels and restaurants before the 30th of June. I mean, there's money sitting there that I didn't even know I had. And it's a reminder that's come up that these vouchers expire on the 30th of June. Multiply that by 20 million people across Australia. Geez, there was a lot of money handed out left, right, and centre. So Phil, it was a very good explanation of it. But the issue is, like, how do you stop inflation? Is interest rates, like, will they just keep raising rates and rates and rates till they get them down?
Well, there's got to be a threshold, right? And this is, and look, we're both not economists, so this is my armchair understanding of it all. A lot of people go, but everything's getting so expensive, and people are saying, oh, give people more money in wages so they can actually afford to live. But you're putting interest rates up. Like, isn't that the opposite of? So you're making it more expensive for people to live, even though the cost of living going up. Isn't that doing it the wrong way? Isn't that counter-cyclical? And the argument is that people have a threshold. So people will spend money if they think they've got money. And to that point, that devalues at $10 because it doesn't buy you as much. So they'll ratchet up interest rates to a point where people stop spending, or they consider what they're spending, or they think about it a lot more, and therefore they curb their expenses and they stop it. So that's how they'll get a control of this rampant inflation, and it is a huge challenge. I sometimes sit there trying to work it out, just going, oh, it's like, you know, and I go my own experience and people I know. I go, well, how much more expensive is stuff going to have to get before I actually stop spending stuff or start thinking about my spending? Are you thinking about your spending more at the moment, Tom, or are you just still spending the same amount of money?
Listen, not that I'm disconnected from the world, but Phil, my behavior is I go into a shop, I buy things, I tap it with my phone, and that's the process. Now, I'm not sitting there on items that are smaller priced items. I can't, like, you know, Luke's just gone and said there, lettuce has gone to $20. Well, listen, I didn't know what the price of lettuce was. I mean, I haven't bought lettuce myself for some time. Have you bought lettuce yourself?
No, not recently. Only because it was too expensive. Because I'm sort of, I find a bit funny story. I was at a barbecue on Sunday or Monday for it was a kids' party, and they're having burgers and stuff, and they bought out this lettuce, and everyone made a big deal about it. Right? It was like, whoa, these guys are wealthy. They've got lettuce. You know, it's like a little bit entertaining. The reason why there's no lettuce, or lettuce is so expensive, because there's not as many lettuces as what there usually is, because there was problems with growing lettuces. You know, supply and demand. But lettuce has become the headline.
But what's that got to do with, Phil? Is that got to do with the storms and the rains, or
I believe so? Yeah, a lot of lettuce come out of Queensland, and I think lettuce supply is down. So therefore, lettuces are more expensive. Mate, you probably remember this. Remember back when bananas ended up being a stupid amount, like $20 or $30 a kilo? It's probably 7 or 8 years, maybe 10 years ago, and everyone was laughing about bananas, where banana milkshakes were, you couldn't get them. You know, because it was supply and demand. A lot of the increase of the cost of goods is a supply and demand a scenario, and sometimes it's as a result of natural weather events. Sometimes as a result of conflict. Sometimes as a result of, you know, politics and diplomacy. We're seeing now the new no workers pick lettuce. There you go. It's probably one of the reasons as well. Supply chain. You see the new Albanese government trying to mend relation with China, and they're talking about, you know, opening up again export potential for wine and barley and lobsters and stuff. Mate, you go out to Western Australia, rural Western Australia, up on the coast, mate, you get a full lobster dinner for about $20. It's because they've got so many lobsters. You know, things move in roundabouts. But what does all this mean, Tom? What does all this mean, and what does it mean for Australian real estate? And to the point, what is going to happen to Australian real estate as a result of this? You're calling peak to trough. Going back to the point, I think we probably fared pretty well during that COVID experience to try and give a level sense for how things are going to play out for Australia. You're calling peak to trough Sydney and Melbourne, which are the headline property markets in Australia.
15 to 20%, and okay. with most of that having already taken place in a lot of those areas that you've just mentioned. What about yourself, Phil?
Yeah, I tend to agree with you, Tom. You got to remember that property in Australia, since they started recording this, I think back in the 1800s, has grown at about, I don't know, 6.5% per year, compounding since that point in time. So we've just had a 30% increase in some markets over 18 months. A lot of it, a lag as a result of the APRA intervention back in 16, 17, which slowed the market down. A lot of it after we got through that initial COVID period, level of optimism, sentiment in the market, all this sort of stuff. I'm going to call about the same, Tom, in those markets. But there is other markets in Australia. Brisbane's still going. They're still moving along, and they reckon that price growth might start to soften at a point in time. Hobart has been the key performer in Australian real estate in terms of capital growth. That's pretty much tapped out. They can't go too much more. There's just not enough people earning enough money to buy that property now in that area, and serviceability is going to start getting tighter, Tom. That's a result of that. But peak to trough, 15 odd percent. But if you bought 18 months ago and you got 30% to come back 15, you're still 15 ahead of the game. And I know, Tom, and this is a matter of timing for real estate investors and how agents can be supporting them. If you're already saying that the market has come off 10%, the data is going to lag by at least 3 months on that. So you fast forward another 3 months, it's come off another 5 to 10%. That's the bottom of the market. That's the bottom of the market. And that's when smart people I know are going to start buying before the data catches up where it is. And everyone says, oh, we're at the bottom now. So you've got a 3 to 6 month window, if you're smart, to get stuck in.
Yeah, I agree with you. My finance broker said to me, you want it to be like this. You've probably got a window of opportunity between late this year and middle of next year. And then the dust is settled and, it goes like this, and then it goes like this, and then it starts going. So it's usually an 18-month period.
Here's a tip. I'll put this out. I don't like putting myself out there, Tom, in terms of predictions, and I'll answer that question in a moment. 6 months ago, we were saying, guess what? Interest rates are going to go up and property will soften. Here's a tip. Property will go up again. And that's a guaranteed rubber stamp Phil Tarrant guarantee. Property will go up in value again.
When?
Don't know. In the future.
Well, I'll tell you.
But I'll be smart about what I'm investing in. There's that question that just popped up on the screen there, Tom. Units versus houses. Absolutely. This is all about asset selection right now. All about asset selection. And there is a lot of unit markets completely oversubscribed. I read a good piece in a paper the other day. Could have been on smartpropertyinvestment.com.au, I can't remember, saying the middle ring houses in the capital cities will do much better. They'll fare much better than unit markets. And I'm talking about sort of, more blue chip, I guess, inverted commas areas around Sydney, for example, where, the cost of living, and to your point, you're not really that connected in with your spending. Those, and I imagine you're a higher income than most, those people with higher incomes have more of a threshold probably to where increased cost of living versus those that are lower income brackets. And we saw it in the papers today about minimum wages getting pushed up and stuff to help. That's who gets hurt the most when it comes to inflation first. So they're saying those middle ring suburbs will continue to probably fare better in terms of softening versus other areas where the impact is higher. The unit market in the capital cities, a lot of them are oversubscribed, Tom. There's still not the people there to rent these places out. I've got a place out western suburbs of Sydney. It's a unit near a Westfields. It should be getting tenanted. Mate, those markets are still tight because the type of people who rent those properties aren't yet arriving in Australia. We're waiting for them to arrive in droves. These people who are going to choose to call Australia home, they normally move to the burbs, and that's where they start off, and they start renting, and they work hard, and they contribute to this economy to a point in time they start buying. There's not a lot of upwards pressure on rents for units in those areas where typically those people would start off in life. That will come in time, but houses are a completely different issue, Tom. And there was a report just yesterday on realestatebusiness.com.au. I'm not sure if you saw it, where I think the Lord Mayor of Brisbane is pretty much going, we're going to start putting council rates up, or we're going to put rates up on properties which people are using for Airbnb and short-term rentals. They're pretty much going, they're quasi-hotels. So we're going to start charging you rates as though you're a hotel, i.e. put these properties into the market for long-term rents to actually relieve some of the pressure people are facing trying to rent houses at the moment. This is what we're seeing. And again, it's a two-speed market. Depends how you want to do it. But that's my views, Tom. There's a lot of ideas wrapped up in the one sort of soliloquy there. But
well, look, Phil, we're going to leave it on this point. And I'll tell you, I did a video interview with Louis Christopher from SQM Research. He's always got strong opinions, and that's what he does for a living, analyze data.
Yeah, he's a smart bloke.
And Phil, he's basically said, don't discount inflation being the driver of real estate prices to actually go up. And he explained that when you've got high inflation periods, people are looking to protect their money. Real estate is a natural protection for them. And because money goes into it, you can see, he goes, when you look at graphs in the past, when you look at high inflation, you see property prices do go up. So there is that scenario that can play out and benefit real estate.
Mate, and that's well observed. I don't know if I don't know if you've looked at your share portfolio recently, Tom. I wish I pumped a whole bunch of money into the share market when I, against my better judgment, for the purpose of diversifying. If I put the same money in property, it would have been sort of 30% up in the game. I've lost about 35% of the value of that sort of initial investment in the share market. So, look, has my property portfolio come off 10, 15% yet? I don't know. And you know what? Am I really too concerned about it? I don't see it every day. I don't see the red there on a spreadsheet when I go into my ComSec on my property portfolio, and I'm not selling, and I can hold that, and I can hold that asset without too many problems. So, property.
Right. Phil Tarrant, we're gonna stay across with our listeners and our viewers every week. I can tell the subjects we're talking about have got high engagement. I can see it. We've still got nearly 100 live viewers watching this as we're speaking, because I think people are trying to make decisions on what they should do, and they're collecting information from every source that they have available. And we're one of those minor sources. But I'm gonna finish Phil on this point and actually say, you've got to forget that some of the best gifts in life come badly wrapped. There are two opportunities here, and that is, you probably have got an opportunity over the next 12 months to get into real estate if you haven't been in real estate, or if you're an investor, to add to your portfolio. That's the first thing. And the second thing, if you are a practitioner that is a real estate agent and is concerned about everything, and you're catastrophizing, I want to remind you, the market's either good for the buyer or it's good for the seller. But if you're a good real estate agent, it's always a good market, because you're putting deals together. And nearly every deal that gets put together in real estate, Phil, is not about a guy trying to make a buck on Bitcoin. It's about people that are making lifestyle decisions. Nearly every transaction, right, is all about lifestyle decisions. So there's nothing to be concerned about. Don't hope the market was better. Hope you were better. And I want to thank everyone that comes on here. We're getting a lot of good feedback there. Favorite show, says Luke. He never misses an episode, Luke Moroney.
He's pretty active these days. Luke is all over the joint.
Yeah. All right.
Tom, let's get Luke on for a chat at some point.
Man, he'd love it, because I think, he texts enough on a chat box. He'd love to come in, and we'll organise it. Luke, hit us up, mate. You've got our details. Hit us up. Phil Tarrant, have a great week, and we'll see you next week.
Thanks, Tom. See you, mate. Thank you.